studying your last two. I swim med tea when they turned in. The staring down to mute. And can lend a pole that sunk he died.
When a corporation purchases several capital assets during the same year, those assets often belong to different Capital Cost Allowance, or CCA, classes. For example, the business may purchase computers, office furniture, manufacturing equipment, delivery vehicles, and construction equipment all in the same taxation year. Each of these assets belongs to its own CCA class, and each class is tracked separately on Schedule 8. Now imagine that the corporation is eligible for immediate expensing. A common beginner assumption is that the deduction is automatically applied to every eligible asset in exactly the same way. In practice, the process involves planning. The tax preparer first reviews all of the assets that were purchased during the year. Each asset is assigned to its correct CCA class. Only after the assets have been classified does the tax preparer review which assets qualify for immediate expensing under the applicable tax rules. At this point, the key question becomes, how should the available immediate expensing deduction be allocated across the eligible CC classes? Rather than thinking about one asset at a time, professional tax preparers look at the corporation's complete list of qualifying assets before deciding how the available deduction should be applied. Think of the process as a simple workflow. First, identify every capital asset purchased during the year. Next, determine the correct CC class for each asset. Then review which assets qualify for immediate expensing. After identifying the eligible assets, determine how the available immediate expensing amount should be allocated across those CCA classes. Finally, record the completed allocation on Schedule 8 as part of the corporation's Capital Cost Allowance calculation. The important point is that classification comes before allocation. If an asset is placed in the wrong CCA class, the immediate expensing calculation may also be incorrect. That's why experienced tax preparers always organize the assets first and make allocation decisions only after the CCA classes and eligibility have been confirmed. Notice that the objective is not simply to claim deductions as quickly as possible. The objective is to allocate the available deduction accurately while ensuring that Schedule 8 correctly reflects the corporation's capital assets and their corresponding CCA classes. The key idea to remember is this: when multiple eligible capital assets are purchased, immediate expensing may need to be allocated across different CC classes. Tax preparers first identify the correct CCA class for every asset, review eligibility, and then determine how the available deduction should be allocated before completing Schedule 8. The process of allocating immediate expensing follows a logical sequence. Rather than deciding on the deduction immediately after purchasing an asset, professional tax preparers work through a series of review steps to ensure the calculation is accurate and fully supported. The first step is to prepare a complete list of all capital assets purchased during the taxation year. This list may include computers, office furniture, machinery, vehicles, manufacturing equipment, or other long-term business assets. Once every asset has been identified, the next step is to determine the correct CCA class for each one. Every capital asset belongs to a specific Capital Cost Allowance class, and assigning the correct class is essential because it determines how the asset is treated for tax purposes. After classifying the assets, review their eligibility. Not every capital asset qualifies for immediate expensing. The tax preparer must confirm which assets satisfy the applicable eligibility requirements before including them in the allocation process. Once the eligible assets have been identified, determine the amount of immediate expensing available for the corporation. At this stage, the allocation process begins. Rather than applying the deduction randomly, the available immediate expensing amount is allocated across the eligible CC classes. The objective is to ensure that the deduction is applied correctly while maintaining accurate balances for each class. As the allocation is completed, calculate the remaining undepreciated capital cost, or UCC, for each CCA class. These remaining balances are important because they will be used to calculate future capital cost allowance deductions in later taxation years. Finally, record the completed allocation and the updated UCC balances on Schedule A. This ensures that the corporation's capital cost allowance records remain accurate and complete. Sometimes there may be more than one possible allocation strategy. A tax preparer may compare different allocation options to determine which approach best fits the corporation's overall tax position, while remaining within the applicable tax rules. The important point is that the allocation should always be supported by proper analysis rather than guesswork. One common beginner mistake is applying immediate expensing before confirming both the correct CCA class and the asset's eligibility. If either step is overlooked, the deduction may be calculated incorrectly, resulting in errors on Schedule A. A useful way to remember the process is through 5 simple steps. Review all purchased assets. Classify each asset into the correct CC class. Allocate the available immediate expensing amount across the eligible classes. Calculate the remaining UCC balances. And finally, record the completed allocation accurately on Schedule A. The key lesson from this slide is simple. Professional tax preparers never begin with the deduction. They begin by reviewing the assets, confirming the correct CCA classes, verifying eligibility, carefully allocating immediate expensing across eligible classes, calculating the remaining UCC, and accurately recording the results on Schedule A. Before completing Schedule A, experienced tax preparers always perform one final review. This review helps ensure that every calculation is accurate, every asset has been classified correctly, and the corporation receives the correct capital cost allowance deduction. The review begins by confirming the list of capital assets purchased during the taxation year. Every asset that qualifies for capital cost allowance should be included, and each purchase should be supported by proper documentation, such as invoices or purchase agreements. Next, verify the CCA class assigned to every asset. Since each capital cost allowance class has its own tax treatment, assigning the correct class is one of the most important parts of the entire process. An incorrect classification can affect both the immediate expensing calculation and future capital cost allowance claims. After confirming the CCA classes, review the eligibility of each asset. Ask yourself whether each asset qualifies for immediate expensing under the applicable tax rules. Remember that eligibility must always be confirmed before any deduction is calculated. Once eligibility has been verified, review the allocation itself. Confirm that the immediate expensing deduction has been allocated appropriately across the eligible CCA classes, and that the allocation agrees with the corporation's supporting calculations and working papers. The next step is to calculate the remaining undepreciated capital cost, or UCC, for each CCA class. These balances are important because they become the starting point for calculating capital cost allowance in future taxation years. Accurate UCC balances ensure that future tax returns are prepared correctly. After completing the calculations, finalize Schedule A. Review the Schedule one final time to make sure every addition, deduction, allocation, and remaining balance has been entered accurately. Finally, update the corporation's fixed asset records. Maintaining accurate asset registers helps ensure consistency between the accounting records and future tax calculations. Before filing the T2 return, Ask yourself a few final questions. Have all purchased assets been included? Is every asset assigned to the correct CCA class? Has eligibility for immediate expensing been confirmed? Has the deduction been allocated correctly? Are the remaining UCC balances accurate? Are all supporting documents available? And does Schedule 8 agree with the corporation's accounting records? To complete this review, tax preparers typically use purchase invoices, the fixed asset register, financial statements, Schedule 8, the general ledger, supporting working papers, and the corporation's T2 return. The purpose of this final review is simple. It helps identify errors before the return is filed, supports accurate tax reporting, and ensures that future capital cost allowance calculations begin with the correct opening balances. The key lesson from this slide is straightforward. Before allocating immediate expensing, verify each asset's CCA class, confirm eligibility, compare all qualifying assets, allocate the deduction carefully, calculate the remaining undepreciated capital cost accurately, and record everything correctly on Schedule 8. Following this review process helps produce accurate tax returns, reliable asset records, and a solid foundation for calculating capital cost allowance in future taxation years.